I'm now in a position to offer you a more advanced definition of technical analysis. My first attempt was that technical analysis is a study of trends and turning points, and that's just fine. But now that we've studied candles, I can take it a little bit further. Let's use our wonderful imagination. Let's assume that we're looking at a share that trades in the London stock market called Anglo. If we looked at what's called a tick chart is a chart that looks at every individual price of Anglo during the course of yesterday. And if we were to examine that chart, we would see that Anglo has traded at maybe 1,000 different prices during the course of the full trading day yesterday. The tick chart is very confused. These prices are bobbing up and down randomly. What technical analysis does is that it gives a level of order to this in that it summarizes all this apparent randomness in a candle, which is, as you know now, the high of the day, the low of the day, the open of the day, and the close of the day. The second thing that technical analysis does is that it takes these individual candles and it puts them together into patterns. And these patterns tell us whether the buyers or whether the sellers are in control. What I'm going to do now is that I'm going to put candles together and look at the definition of a trend. The first thing that I would like to put across is that before we can define the trend, we have to define the time frame. Now, traders use many time frames to make decisions, but the three most important: weekly trends, daily trends, and if you're an intraday trader, you may use an hourly trend as well. Very easily, the weekly trend could be up, but the daily trend could be down. If you're a stock trader, there's a good chance that you would look at just weekly and daily trends. In the Forex market, there's a good chance that you'd be looking at weekly, daily, and hourly. Now, to work out the trend with a great deal of certainty, we have to look at the time frame, and we have to look at the structure of the chart. The theory was first put across by a chap called Charles Dow in 1880. And Dow said so beautifully that an up market in any time frame is defined by a series of rising bottoms, where the market goes up and comes down and makes an obvious support level and then rises again. And then the next time it comes back, it makes a bottom which is higher than the previous bottom. And diagrammatically, I'm showing that to you now. Similarly, a down market is a series of falling tops. And that's the most basic definition of a trend. An up market is a series of rising bottoms. A down market is a series of falling tops. And as I've explained, I like volume to be in sync. If the price is rising in an up market, the volume should be expanding. If the price is falling in a bull market, the volume should be falling. Now, I further looked at trends, and I want to define trends in three subsections. These subsections of trends are what I call a strong trend, a normal trend, and a creeping trend. They're very simple. In a strong trend, the market is rising on rising volume. It pulls back. It makes its first rising bottom. It then advances again on increasing volume. But when it pulls back and makes a bottom which is higher than the previous top. It gives what I call a positive gap. This means that the market players have marked the price up above the last top. It means that we're in a very strong trend, and I show that diagrammatically here. in a normal trend, the price pulls back and comes back to exactly the last top. And that is called a normal trend because that happens most of the time. The price will pull back and the last top will become, the last top, which is resistance, becomes support for the next swing low. Now, as the trend becomes very mature, in fact, what happens is that the swing bottom pulls back to below the last swing top. When that happens, the trend is becoming mature and the probability of a reversal is relatively high. This is called a creeping trend. And what Charles Dow did with this is that he used the relationship between this swing bottom and the last swing high to define momentum. If this swing bottom is higher than the last swing high, the trend is strong. If this swing bottom is the same level as the last swing high, the trend is normal. That's the most common. If this swing bottom is below the last swing top, that's a creeping trend and we are subject to a quick and sudden reversal. Be very careful.